The Bridgewater Fund is the world's largest hedge fund, and when you compare the performance versus that of the S&P 500, you can see why. In the graph below, we can see the performance of both the S&P 500 and the Bridgewater Hedge Fund. You can see the outperformance by the fund, but one notable thing to see is that, for example, if you focus on the year 2000, the S&P 500 rose very sharply during the years before that, but declined very heavily in the years preceding it. But if you look at the Bridgewater Fund performance during that time, it was extremely stable. And that is why they focus on having a low risk vision. They say that it is not necessary to take on more risk in order to obtain higher returns over the long term, which is a very common misconception. But who is the man that's responsible for this outperformance? Well, it is none other than Ray Dalio, the founder of the world's largest hedge fund. Ray Dalio is sometimes referred to as the father of macroanalysis. He has in many occasions stated the principles he uses based on economic and financial understanding. He focuses on recessions and also has developed a theory on the debt cycles that we will be touching upon later. He focuses on minimizing the risk of his portfolios while obtaining similar returns, as we have seen in the previous slides, and he looks for fundamental economic trends and seeks to capitalize only on long-term gains rather than on short-term moves. Over the time, he has developed something called the AllWeather Portfolio, which has become super famous in the world for its low risk and high performance. What this is basically a portfolio that thrives under any economic circumstance, whether it is a bull run, whether it is a recession, whether it is a deleveraging of the super debt cycle that he has elaborated. We will be touching upon that later, but now let's focus on the composition of this portfolio. Firstly, we have stocks, which is the best performing asset class, and he wants to have exposure to this as it benefits from economic expansions. Second, we also have long-term bonds. These are very useful as they manage to hedge your portfolio during economic downturns. And in order to mitigate the interest risk from these long-term bonds and also add diversification, there is also a component of mid-term bonds in this portfolio. And then finally, we have both commodities and gold. Gold or cash is used to hedge against inflation, and cash would be used to obtain the juicy return of high interest rate environments, and then commodities, which are used to hedge against unexpected inflation, as we saw happened after the COVID-19 crisis. So this is the portfolio in terms of percentages. You can see that stocks and long-term bonds are the highest, the biggest, hold the biggest composition in this performance. Stocks holding 30%, long-term bonds holding 40%, intermediate term bonds holding 15%, gold 7.5%, and commodities 7.5%. Now this portfolio right here has an annual return of 4.8% versus a 6.3% annual returns for the S&P 500. Now, these numbers are a little bit lower than you're adjusted to seeing, as I believe that the long-term annual returns for the S&P 500 are more around 9 to 10%. However, these values are adjusted for inflation. That's why they are a bit lower. All while this portfolio has a standard deviation of less than 10%, which is a measure that is used for volatility, and a Sharpe ratio of 0.6. This measures performance while taking risk into account. So it manages to achieve very solid performance while lowering the risk to the minimum, which is that one of the principles that Ray Dalio focuses on. One of his main theories is the debt cycle theory. He calls it this debt super cycle. And what this is that in the economy and over time, there are trends of rising and falling debt levels in the economy. This refers to the debt by the government, the debt by consumers, the corporate debt, and all that. So basically there are periods of, for example, 50 years when all these three start to leverage and take on more debt. And then there are periods where there are deleveraging, when these users start to pay out their debt and reduce their debt levels. He believes that by understanding this, it can provide insights into potential investment opportunities and the risks between the periods. The first one is the leveraging period. This is when debt levels in the economy are rising, and in this period, equities, commodities, and corporate bonds tend to benefit from the leveraging period. And the other one is the deleveraging period, when debt levels in the economy are decreasing. In this period, government bonds and safe haven assets such as gold or even cash tend to be safer. He also believes that one of the most important things about you should focus on when doing a good macro analysis is interest rates and the future expected movements. Investors should be mindful of interest rate trends and their potential impact on different asset classes. We have been seeing this over this year when interest rates have been increasing a lot, and it has impacted different companies, different stocks, and different asset classes. For those investors who want to conduct an extensive macroeconomic analysis, Ray Dalio believes that these 8 should be a solid foundation for that analysis. Of course, there are many more factors you should take into account, but these will do the trick, at least for the start. You should first monitor the economic KPIs, such as GDP growth, unemployment, and others. You should obviously understand the debt level and cycles, trying to predict when the next cycle will come. Additionally, you should focus on central bank policies, such as the movement of interest rates and even quantitative easing. You should focus on technological trends and innovation in the different industries. Also take into account the geopolitical considerations and the geopolitical risk that there is at the current moment, as well as the currency movements, for example, for the 3 biggest currencies, the US dollar, the euro, or the Japanese yen. Additionally, you should focus on commodity trends and the inflation data, as this can help you adjust your portfolio and your asset class percentage and benefit from it. And finally, the environmental, social, and governance, which is ESG, factors. He also developed a framework to be successful that can be applied not only to stock picking and investing, but also to life itself. So I would like to go over it with you guys right here, because I believe he is very right with this framework, and we should use it, of course, for investing. And if you want to use it for other areas of your life, you're also free to use it. I believe it's very solid. So the first one is to set clear goals. Set short-term and long-term smart objectives that are accomplishable, so you can actually benefit and become motivated as you progress. But what do I mean by smart objectives? Well, I'm not meaning that you should be smart when setting these objectives. I'm meaning that they should be, first, specific, also measurable, achievable, relevant, and time-bound. The last one being very, very important, because if you set an objective and say, by the end of this year, I would like to accomplish this return for my stock performance, or these many hours of studying, or these many hours into my side hustle business, it will make you become more motivated, and you will have an objective where you will actually be working for something, and you will have that sort of pressure for yourself to work. The next one is to be able to actually identify any possible obstacles that you will come by in your path. This is important, as you should be able to confront these issues directly. And we also go into the next point with this one, which is to diagnose any problems that you may face. If you are able to evaluate the root causes of the problems and actually address them or develop plans to address them, it will be a lot easier, as if you actually do encounter these problems, you will have an actual framework or a method or a plan to be able to overcome that problem. Which leads us to the next point, which is to actually be able to develop plans. These plans should be adaptable to changing circumstances, as you never know what will go wrong. Of course, you will be able to identify the obstacles and diagnose the problems, but your plans should be a bit adaptable, since those problems will not always be as you expected them to be. And finally, execute the plans. By being resilient and staying focused, you will be able to accomplish anything and be successful in any aspect you actually create or adapt this framework to. So that's all. Thank you so much for watching. As always, you can join the free Patreon for extra content, and there is a link in bio for free stock when registering into the Trade Republic investing app.